And I always do quite enjoy Max Loss, especially when he goes right after me. Max, you and me, we may not be pals, we may not be buddies, but I do respect you. I will say that. Good competitors, Mark. I'll just stay positive about Max Loss. How do you feel about that?
See, like in a previous take, you were bagging on Max Loss, and now you're coming back on a new take, and you're all positive. Like, yeah, you just bite it, Tim. Just bite it.
I'll have to think about that. Maybe bring this Max Gain character into fruition. We'll find it out. But guys, we got a lot to talk about here, and quite frankly, a very important topic. We're all traders. We're investors. We're also we're thinkers, quite frankly. We think about the social contract and society and where things are, and economics is a big part of that. We got into markets pretty much together, Matt, 2005, and I remember kind of building our skills up around the markets, and we all have our own independent way we approach it, whatnot. But at the core of it, we've been through the same timeline in this whole journey, and we saw a crash in 2008. And then we saw the market rally off of the financial markets crisis, and then it would expand, and the Fed started these new programs nobody ever heard of, like QE. Hell, guys, when we started trading, the Fed balance sheet was probably like $600 billion.
Yep.
It's now 4.3 trillion. So, and we've gone through all of these different things, and all of this to set up our topic for today, which is, the business cycles and where are we in 2020? There's history to this, Mark, and I love the topic that you selected. I'm fired up to talk about it. Why don't you go ahead and kind of set up the discussion here, if you would?
Well, I mean, it's just like even if you don't know about economics and you follow the markets, you've probably heard some phrase in recent years like, well, we're at the end of a cycle. We're at the end of a cycle. I mean, that phrase is very commonly used in news analysts and people talking about the economy. And so we're going to talk a little bit about what that is, but we're going to even talk about it from a higher level. Now, the reason we're talking about it specifically this week, because this is the type of conversation that we could have theoretically anytime in the last few years, anytime in the next few years. It's a subject that we all spend a lot of time individually as brothers and sometimes even collectively talking about. But the reason we're bringing it up this week is that at the recent economic forum in Davos, Bob Prince suggested in a news interview that the boom and bust cycle, as we've come to know it, may have ended. And that the latest economic upswing, this boom that's been going on for how long now, Matt? How long has this most recent boom been going on?
127 months, which is the longest in U.S. history, surpassing the dot-com 1991 to 2000 of 120 months.
And so here's Bob Prince on this record cycle, this record boom, saying that, hey, you look at the macro data and you look at the microeconomic data, and he's saying there's not an end in sight.
Mm-hmm.
And so it gets one thinking, is this classic business cycle that is taught in universities around America, around the world, to be quite frank, this business cycle that we're so ingrained with and taught, even as traders, we're taught this business cycle early. Is it now archaic? Now, before we get into that, Matt, I want you to explain a little bit about what the business cycle is, so that people that maybe don't have background in economics or know.
Well, I mean, the business cycle, or otherwise known as the market cycle, it's just when the market goes up and when the market goes down. I mean, the reasons and the economic factors are where it gets a little confusing. But, when you look at the business cycle, the market started going bullish in 2002, 2003. It contracted in 07, 08. Asset prices come down. So when you're really looking at the business cycle, you're not talking about it from just solely from an asset price perspective. You're really looking at it from a GDP perspective, an economic perspective, and you have expansion versus contraction. When an economy is expanding, its GDP is positive gross domestic product. The nation's country, it's producing more goods, making more money. Everybody's happy, bloated, fat, and silly to a certain extent. Contractions are when GDP contracts underneath negative growth for 2 consecutive quarters. And that's when you technically, from an economic factor, see that as a recession. And then as, consumers start losing money, as unemployment starts going up, as inflation spikes, you start to see depression takes in as spending contracts, and that's 4 consecutive quarters of negative GDP. And so when you're looking at the traditional business cycle, Mark and Tim, you're really looking at 4 factors here. The first factor in the business cycle is you really kind of have, what would you call that? The expansion.
Yeah, the expansion, sure.
Right, you have the expansion of it, and so when you're looking at
call it at NBER, right? Expansions and contractions.
Yeah, it's okay. So the 4 stages are, you have the expansion, and what creates the expansion is twofold. Okay, and this is where it gets a little confusing, and I will keep this high level for everybody. The 2 factors that create the expansion are not consumers. They're government and central banks. The first thing that will always happen to create an expansion in a marketplace or an economy is the central bank of that country, and in our situation, the FOMC, they will lower interest rates to encourage more borrowing, to encourage more money, more debt coming into the system, to encourage business activity, to encourage, producers of goods to start putting more money into their businesses, and so on and so forth. And so that's the first thing that happens. The second thing that happens is based on an economic philosophy that really kind of changed. And I think this is where the conversation kind of gets me, not riled up or whatnot, but I think we're in an important stage of the business cycle, because from the 1930s to the 2000s, the business cycle was very consistent in terms of monetary policy, inflationary pressures, asset bubbles, contracting from a interest rate perspective. But we have seen that changes, and the last time we saw such a fundamental shift in how we handled the economic and business cycle was in the Great Depression back in 1929 to 1933. And in 1932, there was an economist by the name of John Maynard Keynes. And he was an economist, a professor. He was a terrible trader, by the way, even though he was proven right at the end of the day. But in 1932, he wrote a book, and he talked about how capitalism is fantastic, but it does have flaws. And in the flaw of a massive economic problem like the Great Depression, you have supply and demand, and there's nobody going to buy things. Right. And so from 1787 until 1932, every time we went through a recession, which was pretty legit about every 4 years, well, the natural free market would take over, and it would take a little bit longer to really kind of go through those contraction phases. But in 1932, when you're dealing with 30% unemployment, because in a typical contraction depression type scenario, guys, we're talking 10% unemployment. But in the Great Depression, where you have a scarcity of food and you have scarcity of product, and you have just, I mean, think about it, guys. Our grandmother was a hoarder, correct?
Oh, yeah.
Absolutely.
But it wasn't just our grandmother, it was everybody in that generation was hoarders, because our grandmother grew up in that environment. She was a young lady, recently married in the 1930s. And, she's concerned about how they're going to put food on the table. And so there's a scarcity and a hoarding mindset. And the economy can never improve in a free market capitalistic system unless in traditional Adam Smith capitalism, unless the consumer base comes back in. But when the consumer base, who basically has 30% unemployment and everybody else can't even afford to put food on the table, they're not going to go buy more things. Manufacturers aren't going to do things. And so what John Maynard Keynes says in 1932, he says, okay, we need to have government intervention. And that's the second thing that really kind of creates this expansion, is based on Keynesian economics. And you can think of Keynesian economics as, government stimulus programs. The New Deal back in 1933, 1934 was Keynesian economics. When back in 2002, at the end of the dot-com market, we had the housing. Say again?
Do you agree with that? At the time, the crisis was so real that the government had a responsibility?
No, I think it was a radical shift in the way we approached economics. I give a lot more credit, because the next recession happened in 1936, Tim. And so it was only 4 years after they did the New Deal and did the Keynesian economics that you had another recession. It wasn't until World War II broke out that the economy really started kicking in the U.S. Yeah. So whether or not they modified capitalism to Keynesian economics, whether it was a good idea at the time or not. I mean, I wasn't there, I wasn't in those conversations, and I can certainly understand when you're dealing with something as dramatic as the Great Depression, people saying, hey, we need to shift the way we've seen things for the last 150 years. So I understand it, even though the next recession 2 years later, and hindsight's 2020 always, but it was really World War II that kind of brought us out of that Great Depression more than anything else, and really kind of what put America on that industrial manufacturing juggernaut that it actually became. But that's what Keynesian economics is. So the two things that creates the expansion is, number one, the Fed will reduce interest rates to encourage borrowing, because borrowing has a bigger impact on the cycle than actual money supply rate does. And then the second thing is the government will come in with intervention programs, stimulus programs, acts of Congress, whatever it is, the Housing Act of 2002, TARP of 2008, these types of programs to really kind of become the buyer. Because if the consumer base is not going to be the buyer during the contraction phase to start the expansion phase, the government, based on the social contract, this is John Keynes making this argument, not myself. He says the government has a responsibility to help the economy. So if the consumer base is not going to be the buyer, it is the government's responsibility to step in and be the buyer until the consumers come back in. And so that's what starts the economic expansion, is Keynesian economics through stimulus programs and the reduction of interest rates to encourage the borrowing process. Now, as we do these types of things, how does the government get money? Well, you can't tax people more money in a contraction phase, which is kind of the third stage in the market cycle. So you can't increase taxes. You can't print money because the central bank prints the money. So you have to borrow money. And so you go into debt at the government level to do the stimulus programs. And you also, and corporations go into debt through the borrowing process to have that expansion. And so as that happens, you're increasing the debt in America. You're increasing the debt to the consumers. You're increasing the money supply as well. So the M2 rate goes up, the debt goes up. And what happens as the markets go up and up and up and up, and typically they'll go 5, 6, 7 years, they'll go up and up and up and up based on this expansion of the debt cycle and the expansion of the money supply.
Slow down for a second, because this is amazing. And you dropped a couple phrases there that I don't even think I know. What is M2 exactly? I know I've heard you guys talk about it.
It's the money supply rate. So okay. It's how much actual currency we have in our economic system. Okay. And so, for example, back in 2002, I believe our money supply rate was about 3.5 trillion. Today, it's over 15 trillion. Okay. Mm-hmm. And that's how much new liquidity we've kind of put into the market. That does not include the debt cycle. That does not include the Fed balance sheet. That's just the money supply rate. But what happens as you increase the debt and as you increase the money supply rate, you also see an uptick in inflation. And that's why for a century now, guys, the market has been an inflationary indicator. And so as the markets go up and up and up, you're seeing asset prices go up and up and up. You're seeing costs go up and up and up. And the Fed has a dual mandate. They have to maximize employment through the monetary policy. And that's very dovish monetary policy, increasing debt, increasing money supply. But as they increase this, they have to control inflation. And so as the asset prices go up, it's a reflection of inflation. And so the Fed will start to increase the interest rate to decrease the inflationary cycle. And just to give you an example of this, back in 1998, 1999, 2000, in the mid 1990s, you had about a 2.2 to 2.3% inflationary rate, as according to the CPI report. But in 98, 99, 2000, towards the back end of that market cycle, inflation was kicking in at 3%, 3.5%, and even in some months at 4%. And at that point, the Fed has to respond to that, because there is nothing more disastrous than if inflation truly does get out of control. And so the Fed, what creates the second part of the cycle is the Fed will start to increase their interest rate to discourage people from borrowing money for cars and boats and trucks and homes and, things like that. But it also discourages, Apple from borrowing more money and Google from borrowing more money and so on and so forth, because you have good debt and you have bad debt. For the consumer, it's typically all bad debt. But to the investor class, to the corporate class, to Wall Street, they'll borrow money all day long at 3, 4, 5% interest if they can show a positive return at 8, 9, 10% interest. Well, as the Fed raises the interest rate from 2.5% to 6.5%, you're borrowing at 10, 12%. That's very difficult to actually show a positive return on the debt. So everybody starts contracting from the consumer base to the corporations. And that's what creates the second stage in the business cycle, which is the peak. And we call it the top, the peak, or whatever it is. Once the peak sets in, everybody starts contracting, GDP contracts, price contracts, and it starts to contract. And the average contraction in price is right around 11 months according to the market cycle as dated back to 1913, tracking the last 13 recessions. So you have an about 11-month cycle from the top to the trough when it comes to that cycle. And in that 11 months, you have it typically from a GDP perspective, you have contraction. And so back in April of 2008, you had the first negative GDP number. In July of 2008, you had the second, and that's when you started seeing the market really kind of spin out of control. Even though it was already going down in front of the actual GDP numbers, it was only going down by about 5, 6, 7%. After the contraction and after all of this comes out into the public, all of a sudden the public starts selling. The public has a scarcity mindset. The public stops the buying process, and it creates more stagnation from an economic perspective. And what that creates is more negative GDP, which is what we call a depression. And so 4 consecutive quarters is what we actually went through. We didn't show a positive stamp on the GDP until April of 2009. So you had an entire year of economic contraction after the top in the market. And so once you have the top,
I don't know how, I'm sure you don't have the stats, but like when you said, like we went through a contraction, I mean, most of us remember that. I mean, but like there's been a ton of retractions in your lifetime, right? Like,
oh yeah, I mean we've had contractions in GDP over the last 10 years, but what we've never had is 2 consecutive ones. Like for example, one of the reasons why, Mark, we were so concerned in 15, and one of the reasons why 2015 was really kind of the 2018's been the worst stock performance year at -8% in this expansion phase of the economy. But in 2015, you went down -1% as well. And one of the reasons why 2015 was kind of a choppy and nasty year for the investor class is because you did ping at a negative GDP number for one of those months. And I believe it was the first quarter of 2015 where we had a negative number. And when you have that first negative number, it's like, okay, it's one data point. And I tell this to traders all the time. One data point is just one data point. The investors, hedge funds, institutions, they'll just, okay, it's one data point. The weather, I still remember it was the weather. We had a nasty winter season in the Northeast, and the weather was to blame for that negative GDP. And the following quarter, we came back in at 3%. So one point on the data is not that concerning. It's really kind of that second point on the data that really kind of creates that recession. And so when you're looking at that recession and coming down, you're now seeing the consumers in the cycle start the selling process. What creates the top is not the consumer selling, because they never look at their brokerage account. They never look at these things in any capacity. It's only when it gets into the social conscious. And once they start seeing recession in headlines, Mark, we see it today with the coronavirus. Once we start seeing the coronavirus all in the headlines, that's all people can talk about, and it creates a certain amount of fear. And then once Lehman Brothers happens in September of 2007, all of a sudden the consumers wake up because it's on CNN, it's on Fox, it's on MSNBC, Reuters, Bloomberg, every financial website is talking about recession, Lehman Brothers. What does this mean? What does this mean? What does this mean? And all of a sudden, that's the consumers come in and sell at the very bottom, and then you start to see the trough come in. And the trough comes in based on what creates the expansion in the first place. The Fed will act with monetary policy by lowering the interest rate, encouraging people to borrow more money, and then you'll start seeing, stimulus programs coming out of the government, and they're always acts of Congress. For example, Housing Act of 2002 and TARP of 2008. So these acts of Congress are stimulus packages that are there to help the economy by being the buyer, and that's what creates the business cycle.
Dude.
Take a breath. Yeah. Take a breath.
All right. If you think about, time out, hold on, theory side of this. When you think about the business cycle though, I mean, the expansion of GDP is one thing, but is that really even? Because the history of it, Matt, it used to go up and down like you talked about. In the 30s, it would go up and then it would come out in this different time. And then in the 50s, it would go up and down, up and down, up and down. Is that really what Bob Prince is saying, is that we're never going to have recessions again, Mark?
No.
Let me rephrase it in a little bit different way, Tim. So what I want to know, I mean, and I want to attach this to Tim's question. What I want to know is what's different this time? Like,
why have we not had a recession?
Yeah, what's different this time than my entire lifetime and really the entire history of like 20th century economics? What's different this time?
What the Fed did in 2008 radically shifted the way the market cycle is and how it behaves. I mean, in the previous, from 1913 all the way into really kind of 2000, the dot-com crisis in 2000, 2002, the market, it was always about that dual mandate, guys. It was all about that dual mandate. When inflationary pressures got out of whack, they would increase the interest rate, and it was just a market cycle that was very, very consistent. I mean, in 98, they went from a 2% interest rate to a 6.5 in 2000, and it crashed the market, and then they did the Housing Act. In 2007, they started increasing the interest rate in 05, 06, 07. They went from a 1% interest rate to a 5.5% interest rate. It stopped the borrowing process. The market went down, and they did their stimulus programs. But what the Fed has done over the last 10 years, guys, is they've really shifted the way that they handle the market cycle. I mean, and the hubris, guys, the hubris of the people at Davos and the people that run these central banks. It was just 3 years ago, guys, when Janet Yellen gave a speech and she said they'll never see another recession in their lifetimes. And, you know, we were telling the joke back then, we're like, yeah, but you're kind of old, you know? So, but there is a hubris at a certain level of the elitist mentality at, you know, the Bank of International Settlements and the central banks around the world and the IMF and, you know, the Davos community and so on and so forth, that they can conjure these economic principles and new, you know, philosophies in a laboratory in the University of Chicago or the University of Austria, Germany, and all of a sudden that's just how it's going to play out. The central banks around the world truly do believe that they can handle any economic calamity that comes at them through the printing of money and the quantitative easing and the bond buying programs and asset repurchasing programs and repo actions. And, you know, it's just increasing liquidity and how they justify it is they say we have muted inflation. And one of the reasons why we have muted inflation is where their monetary policy goes. When you're talking about the traditional cycle, 70% of the American GDP was based on consumers spending their money. You had a 70-30 rule where 30% of the populace controlled 70% of the supply of money. What that means is you have a thriving middle class, is what that means. And the middle class has money, they spend their money, they create velocity in money, money's in circulation around the United States, it creates inflation because of the circulation and velocity of money, the Fed has to act. Well, right now, guys, to create GDP that goes into the 3.5%, 4.5%, 5%, you have to have consumers have money. And right now, in 1982, you had a 30-70 rule. Today, you have a 3 versus 97 rule where 3% of the populace controls 97% of the supply of money. And really kind of 5 people in the US control a vast majority of that. And what do they do with their money? They're not increasing wages. They give one-time bonuses, which means the velocity of money gets sucked out of the economy. And the velocity of money, people haven't been talking about the velocity of money over the last 10 years because of what the Fed has been doing. But back for the 20th century, the velocity of money was the most important economic concept in the world about who has the money and how it's utilized in an economic system, because you can have $100 trillion, but if it's parked in some bank account somewhere, it doesn't create any economic velocity. It doesn't create any monetary velocity. It doesn't create any inflationary pressure because it's just a piece of paper or a number in some account. You have to have utilization and velocity to really kind of kick the GDP. And since 2008, even in 2002, guys, when we did the Housing Act. Now, I disagreed with the Housing Act of 2002. I thought it was ridiculous, and it created an environment for the banks basically to over leverage themselves by basically creating predatory loans in the subprime meltdown. And that's a whole different podcast we don't need to get into. But even in 2002, where'd the money go? The money went to the consumer base through the loan process to purchase new homes.
I bought my first home at 6. Yeah.
You did. And it was based on these principles of no money down, no credit check,
I'll
stated
never forget
income.
it. I've told the story before in the podcast, but I'll never forget it, Mark. In 2006, I did not have a W-2 income or a long history of income. I used to work for Dad in the summers, and I sold pizzas, and I ref ball games.
You just graduated college.
Just got out of college. I was a new trader, young trader. I didn't have a lot of consistency in my history of anything financially.
No.
I walked into a mortgage broker's office, and I found a house. You guys know my old house, and it was a very nice little reasonable home in a nice little neighborhood. And I had an offer on it. I know I could get it. And I said,
Tim, you have no job and you bought a $220,000 home.
He said, can you afford it? I said, yeah. He said, here, fill this piece of paper out. It's a stated income form. Bring it back on Friday. We'll get the loan.
And guys, one of the reasons why the banks were allowed to do that was the agreement the banks made with the Treasury in 2002, to where, investing banks could also be lending firms, and they killed Glass-Steagall in the late 1990s in preparation for this. And, again, another podcast story on Glass-Steagall, but the reality is that's the money went to the consumer base, and it created inflationary pressure. And when it did that, the market responded obviously buy, bullish. And then 05, 06, 07, we start to see inflationary data start to pick up a little bit. Fed has that mandate. They have to act. They start to raise the interest rate so that you're discouraged from borrowing, that money to buy that home or whatever the case might be, and the market contracts. But in 2008, for the first time in our nation's history, instead of putting out Keynesian economic policies to the consumer base, because think about what Keynesian economic policies were when they were created, guys. It was to borrow money from the Fed for infrastructure, to give people a job to build infrastructure. That's what the New Deal was. And so even though some of the people didn't need the stimulus, didn't need the job, they had improved roads, bridges, and dams, and they could produce higher quality because of the improved infrastructure. So the people that got a job, they now had a job, they create money, they create spending, they create velocity. Now everybody's happier in that environment. For the first time in our nation's history, and we can get into this if you guys want to, but in 2008, when they applied quantitative easing, not quantitative easing, but when they applied Keynesian economics, they did the toxic asset repurchasing program where they bailed out the banks. They
first did ZIRP, right? And it didn't work. That's the problem with 08.
That's what they always do first.
They always do ZIRP, which is zero interest rates. They go to zero interest rates. And this
no. That was the first time we went to zero. Typically, they like the low of, it was 2% in the 1990s, the low, and it was 1% in the 2000s. It was only in 2008 when they went to zero interest rate policy. And when that didn't fix the problem, and it never does, guys, interest rate alone don't fix the problem. You have to have that dual situation of stimulus plus lowering of the interest rates. But in 2008, when President Bush, in one of his last acts of office, he signed TARP, which was the bailout of the Wall Street banks. And then when Obama took office, he bailed out corporate America, GM, AIG, the insurance conglomerates. They bought out they bought out the student loan provider, Sallie Mae and Freddie Mac. And so now the money that they're borrowing from the Fed, instead of going to the consumer base in a natural market cycle, now it goes directly to the top of the market. And what we've realized with trickle-down economics is it doesn't do the last stage of trickle down. And so in this environment, what the Fed did in 08 changed the market cycle. Did it change it to a degree that the people at Davos believe that there's never going to be another recession? Well, absolutely not. Absolutely not. But I also don't believe that's what they're talking about, guys.
Yeah.
I think they damn well know there's going to be another recession. There always will be. We just don't know when it's going to happen. I think they're talking asset prices.
Why does Bob Prince say the things he did that spurred this whole conversation? Why did Janet Yellen make that infamous comment that basically nothing bad's ever going to happen again.
Well, it's not just
I
them,
think
by
they're
the way.
talking asset prices.
It's in the academic journals. It's in the economic theory journals.
Oh,
It's in
go
Princeton and
read
Harvard and
any
academic journal.
article from the Bank of International Settlements.
Yeah, they're all talking about it, and they're talking about it for like 5 or 10 or 15 years. And Mark, you know how academic research works. Stuff that they started working on 5 years ago is the stuff that's going to be implemented now. They're all moving towards this modern monetary theory. And Matt, let me try to high level this for my brain a little bit and see if I got anything wrong here. You let me know. Essentially, over time, we have moved from pure capitalism into something else. Whatever that else is, we can talk about. Neoliberal, all these different policies. But at the core of it, it really started as a response in the Great Depression with Keynesianism.
It always does, Tim.
And now here we are 70, 80 years later, right? Whatever the number is. And now we're talking about a $4 trillion asset in the Fed balance sheet because they've always gotten away with it. Like every time there was a crisis, 1982 recession, they have 10%, interest rates and all this. So what do? The Fed gets aggressive and they do things they never did before. And then in 2000, they do things they never did before. In 2008, they do things they never did before, and they're getting away with it.
Economic pain does lead to the consumer base accepting radical changes.
Mm-hmm.
I mean, there's a reason, guys, that in the 1930s, you had the rise of fascism and communism, radical messages, pure radical messages. I mean, you think about Adolf Hitler, he wrote Mein Kampf in what, 1923, 1925?
Mm-hmm.
And, he became German chancellor in 1932 with a radical message because, Germany had saw the death of the currency, the German Deutschmark in 1923. Just talk about the worst economic condition that you could ever even face is what Germany was going through. And you listen to radicalism, right? And so from an economic perspective, when things are rosy, nobody wants to listen to how we need to make these changes, right? And so for the first 150 years of our existence in America, in this amazing experiment that we call America, you had ups and down cycles, there's no doubt about that, but you never really saw anything like the 1930s, guys.
Mm-hmm.
And quite frankly, from 1879 to 1907, you had zero inflationary pressure because you had a fixed money supply as tied to gold. And so you didn't create an inflationary pressure. It wasn't until they created the Fed in 1913 and the currency crisis of 1907 that you started seeing the financial and economic policies start to shift to where they allowed, lending banks to also be, investing banks. And, that created an asset bubble in the 1920s to where we were over leveraged at the banks from 30 to 1. And when you have to deleverage a bank from 30 to 1 back down to a traditional fractional banking system at 10 to 1, you're talking about massive economic calamity in that environment. And when you go through these tough economic conditions, you listen to radicalism. And that's why in 1930s, that's when you saw capitalism change to Keynesianism. And that's why in 1980 to 1982, you saw Keynesian economics, be kind of modified into neoliberal economic philosophies as promoted by
the way. That's true of almost everything. That's not just economics. People give up their liberties during times of crisis.
They do it all the time. They do it all the time.
History of humanity.
But again, why though? Because
they're afraid.
Why?
Fear
No,
is a more
it's because we went through hyperinflation in the 1970s, and we went through a Mark. I remember locking the gas tank growing up.
Oh yeah,
I remember those times.
Those
right?
Those little Jensen kids were shits. We couldn't let them steal our gas.
Yeah, but that was everything. You went through gas lines and oil embargoes and shortages and hyperinflation because of the debt cycle, and so you had a radical message come in.
Totally just triggered a childhood memory. I remember being really little and Dad just swearing because he drove a little Bug when I was a 4, 5, 6-year-old, 7-year-old. Matt, were you even born? Like, how much older am I than you? 9 years?
7 years.
No, I'm 7 years. So you might have been just a baby. Tim, you were just a gleam in the milkman's eye because you obviously are not our father. So, and I remember Dad swearing because we were in a gas line that was like, to my little brain, remembering back was just like an eternity. But
Mark, they would sit in gas lines for hours.
I mean, I remember, oh my gosh, you just totally triggered a
And,
childhood
and
memory.
and in some states, Mark, if you didn't have less than 50% in your gas, you couldn't fill it up. And then you had odd and even days. And when you go through those types of situations, your father gets pissed off and he starts, we need change. And here you have Ronald Reagan. He represents the change. And so you had this shift from, it wasn't really Ronald Reagan. It was really Alan Greenspan, who was an understudy of Ayn Rand. And Ayn Rand was the philosopher who wrote, Atlas Shrugged, who really kind of brought in that neoliberal, trickle down economics, zero regulations, create a unadulterated version of capitalism. Basically, let the producers, let the entrepreneurs do whatever they want, and if they have to step on the toes of the consumer base to do it, to hell with the consumer base. And the whole philosophy was, if we deregulate everything and let Wall Street and corporate America do whatever they need to do, they're going to create jobs, which is true, and they're going to see wage growth. But we really haven't seen wage growth over inflation in any capacity in the last 35, 40 years. And so that shifted the model. And then coming out of the subprime crisis, which was, in my estimation, the worst economic crisis we've seen since the Great Depression, again, radicalism takes hold. Your economic philosophies evolve. And now what we live in, and this is what brings me back to the question, is the traditional market cycle dead?
I mean, because that's a big question. I mean, are they right? Is the hubris right? Maybe it's not. I mean, it's not hubris if they're right, right?
Well, in this market cycle, now you have twofold. You have neo-Keynesian economics and you have neoliberalism is what you have. You have trickle-down economics and then you have corporate socialism. And guys, that's creating a horrific environment where you see the imbalance of money supply between the consumer base to the investor class, to the corporate class, to the Wall Street class. And when the imbalance of money supply gets so dramatic, guys, you typically have revolution is what you typically have, because the consumer base gets so pissed off. And that's why you're seeing so much support for Bernie Sanders and these far left, people, as they're saying, well, I mean, if they're going to do it, let's do it for the consumer. And so you're starting to see that happen because these policies have really kind of expanded to a level that we've never seen before. We've never seen corporate socialism in America. We've never seen Wall Street socialism in America. And that's what we're living in. And that's where this hubris of Davos and Janet Yellen and all these central bank presidents and so on and so forth, they think they can prop up this market through their quantitative easing programs, through their asset repurchasing programs, through the quantitative easing. They think they can prop up these markets forever based on their new modern monetary theory, and they're testing it out in this vacuum.
Matt, I have an important question. How many times in the history of the entire human race has this current theory been tested?
It's been tested many times, Mark. This is not a new philosophy. It's these types of policies have led to the death of over 500 currencies since the first currency was created. And
okay, so how many successful times?
Never.
Oh, so we have example of central bank intervention. Let me get this right. So we have examples throughout history of, maybe they weren't called central banks, but they essentially acted like central banks, intervening to try to prop up and stabilize economy, currency, whatnot, and they always failed. But this time it's different.
Well, and that's why I say it's the hubris, Mark. It's the hubris of these individuals in a laboratory somewhere conjuring these ideas like they're new, and they're not. I mean, America didn't create quantitative easing, Japan did. And Japan's went through 3 decades of economic stagnation because of that. So when you look at it, has these policies ever actually been successful long term? No, they've been successful in the short term. But in my opinion, and this is again just my opinion, at some point this house of cards will fail.
And you're not alone in that. I was reading up this past week on Austrian business cycle theory. And, I don't want to get too complicated into this, but it's not, this is not just Matt Just opinion. There are people that look at this from an academic standpoint and are like, listen, this whole lowered market rates and injections of new credit and money produced out of thin air, this Austrian business cycle theory says it must eventually end in a bust. These policies are born out of a theory of crisis. So we had 2008, 2009, we had a crisis, right? Like
Yep.
most people would say that's a crisis. And so something was born out of that. Now, eventually, at the end, this theory, and I was digging up, I was going all over the internet, Googling, it's not alone. There's lots of theories and lots of different reasons to say, listen, eventually this has to, by the natural order of things, not end well.
No, it's just a matter of time frame, whether we're talking years or decades here. But I'll give you an example, Mark. 1918, World War I ends. And the Versailles Treaty of 1919, which officially ends World War I, they put $32 billion of reparations on Germany, which was basically the debt burden of the UK and, Russia and, the Allied partners. And Germany, who was the number one economy in the world, number one military in the world, their currency was very, very strong. In 1914, the German mark to the US dollar ratio was 4-1, I believe. Well, what the Weimar Republic, who took over after Versailles, what the Weimar Republic did is they started printing money to pay down debt. And this created a hyperinflationary situation because unlike America, Germany was not a reserve currency. And so as they were printing money to pay down debt, they created a hyperinflationary scenario where by the end of 1923, October of 1923, you had a 4.3 trillion to 1 US dollar ratio. And my math might be off there, but it's close. It might've been 2 trillion. I can't remember off the top of my head, but I do believe it is either 2.3 or 4.3 trillion to 1. And people were literally burning paper currency just to keep people warm. Like they were putting it into wheelbarrows and sweeping it down the streets and so on and so forth. Well, what's the difference between what America is doing, who is the number one debtor in the world, who has printed more money than anybody else around the world? The number one equation in what props this entire system up is the fact that the US dollar is the reserve currency of the world. And unlike other nations who has to deal with more inflation than we do, we export our inflation to the rest of the world because our money supply and our currency that we create doesn't only stay inside the United States. It goes to China, it goes to Japan, it goes to Australia, it goes to Europe, it goes to Russia, it goes to everybody around the world for international trade from a corporate perspective, a central bank perspective, or whatever the case might be. How this house of cards fails is if the dollar continues to lose reserve status. And over the last 10 years, guys, we went from 70% reserve status to about 60% reserve status. Oil is no longer solely priced in US dollars. It's now being, Saudi Arabia is even selling oil in non-US dollar transactions. And so you're starting to see a shift, especially through the emerging markets, Brazil, South Africa, Russia, China, India, and other countries like Turkey to shift away from just solely dollar dominated type currency transactions to more baskets of currencies like the NDB or the SDR. Out of the NDB is the one through the BRICS, and the SDR is the one through the IMF. And so these baskets of currencies are starting to take greater importance in the reserve nature, and the dollar is certainly still going to be a part of that. But as money comes home, you will start to see inflationary pressure, and that will force the Fed to act a little bit more aggressively, in my opinion. It won't be this Fed, and it might not be for 10, 20 years. But to me, this great experiment that we've been playing out over the last 10 years, and these central bank presidents and the Davos community and so on and so forth, who don't believe we're ever going to see a recession because these monetary policies that have been applying over the last 10 years is going to prop up the market over the next 100 years. That's absolutely insane to me. It's absolutely insane. Mm-hmm. And I just want to be very, very, very clear here. Recessions are not bad. They're not bad. In a recession, it goes from 4%, which is the natural unemployment rate, to 8 to 10%. Most people still have a job. Right? When you reset the inflationary scale in a recession, asset prices come down, certainly, but doesn't that allow us, the investor class, to get into Amazon at 700 instead of 2,200?
You would think so, yeah.
Okay.
I mean,
so and you know what,
just
guys?
do those fractional shares that Fidelity thought about.
Well, that's dumb too. but the reality is, I do not believe the market cycle is dead. I simply believe the market cycle has evolved. And what you're going to see in the future, in my opinion, is the expansions will see greater price action, and the contractions will see greater decrease in price action. And the velocity of asset prices will move faster over time in the future than they have in the past.
And that's
the
where
cycle is not
my takeaway
dead.
is. That's where my takeaway is. As I'm sitting back and I'm thinking about this whole thing and the conversation I'm enjoying so much, the reality is we have evidence it's not a dead boomer bust cycle market happened just last year. In
Hey,
2018,
we have a call in right now. We have
do
a call in. Matt Justice, this call is for you. Hold on one second. Matt
It's
Justice,
Max loss.
could you promise me that this is going to happen? I've been listening to you for the last 15 minutes in pure ecstasy at the doomsday scenario that you've painted.
I am not a doomsdayer, Max loss.
I appreciate this. Has been like porn for my mind the last 20 minutes. Thinking of the hubris of the human condition and the utter destruction of individuals that are ill-prepared, that are uneducated. Matt Justice, I kind of have a crush on you right now.
I like it. I like it. I like it. And I'll tell you the one key factor that really kind of understands that you're at the back end of a cycle is the irrational exuberance that you see of the consumer base finally coming in and chasing the dragon.
Mm-hmm.
And we've been starting to see that. We've been starting to see that. I mean, it was the Davos community that was talking about where they're going to put their money, and the millennials like, we're going to go to Robinhood and buy Tesla because Tesla's going to go to 7,000. And we're seeing that. And like Greenspan said many years ago, the market can stay irrational. The market can stay irrational longer than you can stay solvent. And so, you know, I still believe we're going to see a higher high in the market. I still believe we'll see asset prices appreciate.
That's the big, like if I was playing like interviewer, which I'm terrible at, I would be like, all right, so Matt, so I buy it. Because I do. I genuinely buy everything you've been saying. I think you've done a brilliant job of this. But how do we like incorporate? This is where like you have these people out there that are the doomsayers. And they never give you a practical plan. Like, how do we go about in our day-to-day actions? Like, because I 100% believe you, but we don't know when this is going to happen, right?
Well, you know, I was asked this. I was teaching about 3 months back, Mark, and I can't even remember where I was. But somebody asked me a class. I was teaching the market cycle, and usually when I'm teaching the market cycle, I usually about 2.5 hours in detail on the market cycle. And I think I spooked the class. And I wasn't meaning to. I was just talking about.
Right?
You know, I wasn't meaning to, but they asked me a question like, Matt, when is this going to occur? And I just said December 15th. And the entire class looks at me and they're like, oh my God. And I'm like, no, I'm kidding. I don't know. Like literally, nobody knows when this is going to happen.
Oh, I ordered 250 gallon pounds of rice for my food storage while you've been doing this podcast.
Get your guns, get your ammo, get your gold, and get your rice, and get your get in the mountain somewhere, right?
But yeah, in the prediction podcast, Matt was the most bullish.
Because
See, I am. I am. I think they can prop it up longer than we believe they can.
Yeah.
But well, I should say longer than most people believe they can. But I do believe it has a nasty ending to it.
It's got to, right? Like
that's my premise. The whole thing.
But here's the thing, guys. In every one of these cycles, when you look at the dot-com cycle, when you look at the subprime cycle, right, you see certain technical things in the market that always occurs, right? And so as asset prices are going up and up and up, the first thing you're going to see in the marketplace is a concept of slowing momentum. And as a trader, you know, and I know, Tim, we don't believe in Elliott wave or Fibonacci, but as a trader, I still wave count. And when I'm wave counting from the higher low to the higher high, the slowing momentum of the market is kind of what you're looking for in that contraction type area. And to give you an example of this, you know, let's go back to, you know, the subprime market when they were doing everything they were doing. Well, in 05, 06, 07, you basically saw in 07, the market still showed bullish tendencies, but it did not show as much bullish tendencies as it did in 06 or 05. And so that's the indication as the Fed is raising the interest rate that they're slowing down. They don't stop the purchasing power. They just kind of slow it down. They contract it a little bit. And you can kind of see that in the market when you looked at the two waves. The wave one in 06 went from about 1230 in the S&P to about 1456 in the S&P. So what is that? How many points is that? 1230 to 1470.
That's about 240 points. That's 20%. 20.
Yeah. Okay. So good little expansion there. Mm-hmm. In 07, as we were coming into 07, it went from the next wave went from 1370 to right around 1520. So you started seeing a little bit of contraction. And so the first thing you're going to see is the market just starts to slow down its expansion as it prepares for what we call the peak in the market cycle. Now, the peak occurs from a technical perspective, in my opinion, and when you set resistance in June of that year at 1550, and then you double topped in October of 1550, that was the first time resistance had held in that market cycle. And so in October of 2008, or excuse me, 2007, is when the market double topped. And historically, that's when we look at the peak, is when we see that double top and resistance finally doesn't fail. It finally shows its sharp teeth and says, nope, we're holding. And then you see the third step in the reversal called the double bottom. And the double bottom happened in November of 07. And that creates, and so from June to November of 07, you create a technical condition called the M formation, which stands for murder. It's just a bearish, technical pattern. And that's based on these economic factors that are playing out in the market. And so for 6 months, the market went stagnant. And then in the first time in January of that following year in October, the market broke its support level. And then the market just started doing lower lows, lower highs. And then finally it comes into the news. So how do you prepare for it? It's like what Jesse Livermore said. You trade with your eyes. Yeah. Right. Your mind prepares you for things. Okay. You never want to trade with your heart. I mean, that's just silly, but your mind prepares you for these things. It's like that Boy Scout motto, be prepared. So we're prepared of these market cycles. We're prepared that these cycles can come to an end, but we always trade with our eyes. And so when you saw the double top, double bottom in 07, and when you saw the breaking of support in 08, and you finally saw, in April of 08, you saw what's called the kiss of death, which is the first retracement on a weekly chart, retesting those old support levels. At that point, you're in a bearish market, and then once that bearish market takes hold, the consumers stop the spending process, businesses contract, Lehman Brothers goes out of business, Bear Stearns goes out of business, AIG gets bailed out, and then October of the following year, we saw all the ZIRP and the quantitative easing and kind of the modern monetary theory start to play out that Bernanke really kind of started.
I got a question for both of you guys. Hobbes, Locke, Rousseau, through Keynes, all the way here till 2020. Here we are in a modern economy, modern world. Does society, government, central bank, let's say that it wasn't a private bank and we actually could regulate it, do we have a responsibility to try to positively affect employment and economics and make sure things are stable?
I understand why the government shifted their economic policy in the 1930s. I understand that. But even John Keynes would tell you, if he were alive today, he would fundamentally disagree with the application of it in the 21st century. 100%. Fundamentally. Yeah. Because the one mistake I think John Keynes made was he trusted government to pay down the debt cycle. And over the last 2 decades, from President Bush to Obama to now Trump, we have not ever tried to pay down that debt cycle. And so when you're talking about the original question, is the market cycle dead? No, it's not dead, but it is certainly evolving both from a market cycle condition, a central bank monetary policy perspective, as well as just how we apply Keynesian economics in the first place. So my takeaway from all of this, and I don't have the answers. I don't think anybody has the answers, because we're experimenting this in a bubble to a certain extent. I simply believe this: market cycle will be what it is. We're going to have recessions in the future. We're going to have bear markets in the future. They'll have more velocity to them because there's more money at play.
Mark, what about you? Do you think there is a role for intervention at some level?
That's such a trap question.
Yeah, of course it is. Does economics fit into the social contract, guys? Because once we answer that question,
the social contract basically states, what does the government provide us, and what do we give up to get that government, things, right? And so when you're talking about the social contract, you're talking political, you're talking economic philosophy, like, for example, in a capitalist economic system, according to John Locke, the government is supposed to provide infrastructure and security, both in terms of domestic police to protect the rule of law and to protect our foreign interest. Mm-hmm. And so infrastructure, as well as that, everything else was up to the individual and the corporation. Obviously that shifted under Keynes when, he said the government has a responsibility to step in and be the buyer of the economy. And so, has the social construct changed over time? Absolutely, 100%. I mean, you're even seeing that with healthcare debates right now.
Mm-hmm.
Does the government have a responsibility from a healthcare perspective? Because obviously those things have changed. And even though I believe in the Constitution, I also believe that, our amazing founding fathers 250 years ago didn't have all the answers for the 21st century.
Mm-hmm. Mark doesn't want to be trapped.
Listen, I choose Batman.
Oh, I wish that we had a banking system that was much more transparent, that would come out and actually benefit people. I don't have as big of a problem with the monetary creation as you do, Matt. I have a problem that it's only benefiting one certain class of people, including.
Then you should have a
welfare.
problem with the monetary philosophy because it's benefiting one person.
I mean, no, just the idea of them using money to try to help the economy at times during economic crisis. I'm okay with the concept.
You're not supposed to do that at the top of an expansion of
I get it.
400% price increase, though.
I understand how it's different. I feel like so much of this is academic hubris that has just gone completely off the rails because they've gotten away with it. They were facing this crisis and they had never expanded the balance sheet to what it is. And then they did, and it worked, and then it kept working. And they're like, oh, guess what? This is working. Let's just keep doing it. And I think they're running this thing down a very, very dangerous path because of the size and the nature of where we are. And the idea, are we never going to have a bust again? That is the silliest question. What was that guy's name? Bob Prince, Mark? Who's he?
Listen, when we're going linearly down the production notes, I erase them on my Word documents as we're moving down to the next detail. Do you think I know who that motherfucker is? I have zero idea.
Well, here's the big question you put in the notes, and I like it. Can a boom be held up indefinitely if central banks beat down the market interest rate to zero or even push it into negative territory? No. Matt, eventually
look at international markets.
Happen. Look at the coronavirus right now. Look at things that can happen that are not planned. Tim, conflict, weather.
You're talking black swan events.
Yes.
Right. And no, like monetary policy can help in those environments, but it can't stop if the public is so scared they won't buy things.
No. If consumption goes down and people change, and of course, that's economics. It's the history of humanity for 2,500 years. Of course, we're going to have another bust at some point. Do not forget history. I think there's a huge lesson here, and I appreciate, Matt, you walking through a lot of it there because it's just fascinating to me to even put my head to it.
I hope it helps people understand what the traditional market cycle was and how it's evolved over time. And what we're saying is it simply creates more velocity, no doubt about that.
Mm-hmm.
Can they have muted inflation forever? I don't know. I mean, these are questions that will only be answered as time plays out, to be perfectly honest. It's like I was talking about the other day to a bunch of people. All we can do is make decisions based on what we know today.
That's right.
But we have to be able to modify our approach to the market, our approach to the economy as we see things shift. And even though I fundamentally disagree as an Adam Smith capitalist, I fundamentally disagree with policies that go against the free market. And that's why I hated when Jamie Dimon went over to the Chicago Mercantile Exchange and increased margin requirements on gold so he could kick out the speculators and he can corner the marketplace. Yeah. I hated it when Elon Musk tried to manipulate the short traders 2 years ago by lying that he had a Saudi Arabian buyer at 420. I can't stand market manipulation. I believe in the free market. I believe in capitalism to my core, and it saddens me that we have evolved and changed so much that we've forgotten about the history of what created this great country. And what created this great country was capitalism. That's what it was. It wasn't crony capitalism. It wasn't corporate socialism. It wasn't Wall Street socialism. It was capitalism that built this great country, that made this great country the number one economy in the world, number one currency in the world, number one military in the world. We're not the brightest, we're not the best, but we're but we have the biggest military and the biggest currency and the biggest market that everybody wants to come to. And it was because of capitalism. It wasn't isolationist policies. It was capitalism. And that's why people wanted to come here to get access to our free markets. That's why that's why immigrants wanted to come here. That's why our people came here. That's why the Justice family came here, is because we wanted to get away from the economic persecution we were dealing with in Europe. And we wanted to come to an environment where we could go work and provide for our family and so on and so forth. And
well, then why are there rumors of some of our ancestors being Kentucky riverboat pirates?
Well,
like,
listen.
Did we come over to rob the hardworking?
We might have.
We might have just been moving moonshine down the river.
But we probably were moving moonshine, knowing some of the Justice history.
Last thing here, though.
Yeah.
Going back to Mark's question, what would we do? Aren't we still going to invest in the same? We're still going to buy stocks, guys. We're going to just.
Well, let me finish my point.
Yeah.
Even though I disagree with it, you can't fight it.
Yeah.
Right. You can't. It's just like you can't fight the Fed. You can't fight these government policies. They don't listen. They don't. The government used to be by the people, and now it's not. It's bought for and paid for by Wall Street and corporations, and the same thing with the central bank. And so you can't fight it. My capitalist heart dies a little bit every single day that they do repo actions and further modern monetary theory. And it disgusts me that certain politicians in America, will hate on one side of the equation and claim we're capitalists, but then, hand over billions upon billions upon billions and billions of dollars to Wall Street and corporations. And it saddens me. But, it's like Keith King says, Matt, shut up and buy.
That's kind of where we are. And then obviously do the things like that we have learned and we teach our students over at Tackle Trading in these podcasts so many times. Learn how to hedge it, learn how to play gold markets as well, learn how to use put options to cover when you need to, stop losses, position sizing. There's a great lesson.
Portfolio diversification.
So many times. Yeah. It's simple stuff. Learn the products in the market. Don't be afraid of the market. Yeah. they've all lost their mind. It's gotten to a point here in 2020 where you got to scratch your head. But that's where we are, guys. Modern monetary madness. It is what it is. Love the topic, boys. Great job on that one. We're going to take a break and come back with a quick game. But first, a live read from, I don't know, is this Max Loss, Max Gain? Is it just Coach Mark? What are we going to get here? I have no idea. Mark, you're up.
Oh, Max Loss is in a orgy bath of dreams of the nightmare scenarios that Matt laid out. So you're going to have to deal with just good old fashioned Mark.